Hello, my name is Shreyans, and in this video, we are going to do a basic financial analysis of a very well-known company in India. And the family that has operated this company as well is extremely well-known for not just its business acumen, but also philanthropic purposes and philanthropic endeavors. And one of the former CEOs of the company is an extremely well-respected business tycoon in this country, not just right now, but has been for the past several decades. The person I'm talking about is Mr. Azim Premji, and the company is, of course, Wipro, right? As you might know, Wipro is an IT services, consulting, and business process outsourcing company. So it creates software-based products and platforms and provides those services to other businesses, right? Now, let's start with the financials of the company. Then we'll look at the metrics and finally move on to the highlights. Please remember that this is not financial or investment advice. We're just trying to understand the financial position and performance of the company, right? So if you look at the revenue, EBIT, and PAT, they haven't gone up very considerably. In fact, the growth has been poor and very low compared to other companies in the industry, right? So revenue is about 61. Revenue has gone from about 31,000 to 61,000 crores, slightly less than double. And a similar story is there in EBIT and PAT from 5,600 to 10,000, from 5,200 to 9,700 crores the PAT. So, and if you look at FY11 figures, you'd find out that, TCS was slightly bigger than Wipro and Infosys was actually smaller than Wipro in terms of revenue. But right now, TCS is considerably bigger than Wipro, and Infosys has also become the second largest by revenue after TCS. So you could see that, the growth hasn't been the best for the company, and which is why it has, kind of falling behind in the industry as well. If you look at the cash conversion and the growth in CFO, the growth in CFO is slightly better, right? And the cumulative cash flow is almost equivalent, to the cumulative PAT. So it's about 76,300 or 400 crores. This is about 70,700 crores, right? So very small difference, a couple of percent difference there only, right? Now talking about the cash flow from investing and cash flow from financing. So within investing, there have been significant transactions related to investments. So just like any most of the IT companies, right? These companies generate lots of cash and they temporarily place those cash as investments. So lots of buying and selling of investments have been going around. In addition to obviously the reinvestment, continuous reinvestment into assets, but primarily there have been a lot of financial investment transactions. And the reinvestment doesn't make up a very large percentage of the investing flows, right? Cash flow from financing, the company has been consistently paying out dividends, but that is one good thing. In the initial years here, the company had a lot of borrowing transactions as well. Then for a few years, the company did not have borrowing transactions. And again, in the recent years as well, the company has had borrowing transactions. So raising borrowings and repaying borrowings, both of those transactions, dividend transactions or dividend payments have continued throughout, right? Now looking at the equity position, the equity is up 2.5x, slightly greater than revenue and PAT, right? And current assets, if you look at it, so current assets have gone up 2.3x, and current liabilities have gone up 1.8x, more or less in line with PAT, or sorry, in line with revenue, so to speak, right? And a large part of these current assets would actually be investments that the company holds, right? Non-current assets have also gone up to almost 2x, and which is again in line with revenue. So we can understand that the asset utilization has broadly been maintained, right? Non-current liabilities have been very insignificant, so to speak. So right now, non-current liabilities stand at 3,500 crores versus an equity of almost 55,000 crores. And again, if you look at the total liabilities, so the total liabilities are about 25,000 crores, slightly above than that, and the equity is about 55,000 crores, right? So sorry, the current assets are about 52,000 crores. So the current assets are sufficient to cover for the total liabilities of the company, which is quite characteristic of an IT company, right? Now, looking at the growth rates, as we talked about the growth rates. So the growth rates, in fact, if you look at all these years, then there is just 1 year in which all three revenue, EBIT, and PAT have been double-digit growth rates, right? In fact, in all the other years, if you could see, in most of the years, all three have been either single digit or in fact some of them have been also been negative, and just no other year in which there have been double digit growth rates in all three. So this is why what you can see that why the company is sort of falling behind its competitors in the industry, right? Which is not the best of signs for this company, right? Cash flow is understandably, growth in cash flow is understandably volatile. Growth in equity is also surprisingly slight volatile at few places where it has gone down, right? Growth in assets has been more or less consistent, although in the recent years, again, it has been, the total assets have also declined, which is sort of surprising, right? Current assets less current liabilities is understandably volatile because, there are a lot of components moving up and down. Liabilities also, I mean, on an overall basis, the liabilities are very comfortably covered. I mean, they are not very significant as we just saw, right? So the growth doesn't matter too much here. Now, if we look at the return on capital and the return on equity, right? So in the initial years here up till this point, if you could see, it's just a very split performance. In these 5 years, both all the return ratios were greater than 20%. In the recent 5 years, all the ratios have been less than 20%, right? So this seems to be some sort of problem for the company that the return ratios are not the best. In fact, they are quite below the other competitors like a TCS or even an Infosys, so to speak, right? The margins have broadly been maintained, so to speak. The decline in margin is not as evident as the decline in the return ratios, right? So the margins were healthy in the 18% here, right? EBIT and PAT margins, and they've slightly declined by a couple of percentage points, but in the recent years they've also been maintained. So a slight decline, but not a very prominent decline, right? And the similar story kind of goes with the PAT as well, PAT margin as well. Now, talking about asset utilization, so asset utilization also has a bit of a similar story here, right? Good here in these 5 years, and after those 5 years, slightly lower number. So, although the performance has been consistent, but it is sort of a split. From FY11 to FY15, it was slightly better performance, and from FY16 to FY20, slightly lower than that, but still consistent, right? So, this seems to be a sort of challenge for the company, right? Now talking about the leverage and solvency related metrics. If you start with assets by equity, it has never gone up. It has never exceeded 2x. So comfortable on that side. The liabilities, as we talked about, are not very significant. And if we talk about the CFO to PAT cash conversion, so there have been 4 or 5 years, so 1 year here, and then 4 years here where the CFO has been greater than PAT. So that is one good thing, that the company's cash conversion has been very good, especially in the recent years, right? Now, if we talk about the net cash flow, so net cash flow is a very big positive number, around 7,400 crores, right? And again, this is characteristic of an IT company because they generate a lot of cash. So they have enough cash to pay out dividends and also invest into their assets. And the excess cash is placed as deposits or investments, financial investments, right? The difference between current assets and current liabilities, I mean, as we saw, more or less this has been in line with revenue. This is something that we've seen, definitely slightly volatile, but more or less in line with revenue. Non-current liabilities to equity, we've seen that very insignificant non-current liabilities, I mean, and very comfortable, solvency position, so to speak. All right, now let's quickly wrap up with the highlights. So if you could look here, the limited growth in revenue, EBIT and PAT, very limited, or you could also say it's no, it's from compared from an industry standpoint, it's been poor growth versus other companies in the industry, right? CFO has been greater than PAT in 5 out of the last 10 years. Cumulative CFO is slightly lower than cumulative PAT. So if you look at the cumulative CFO upon, so it's about 98.2%. So it's almost equal, very, very close. Continuous reinvestment into assets and a lot of investment transactions make up the cash flow from investing. And CFF includes borrowing transactions and dividends as well. Dividends have been paid throughout. Borrowing transactions in the initial years and then also in the most recent years, with not a lot of transactions in the in between years, right? Decent growth in equity, the leverage of the liabilities are sort of immaterial, and significant investments are held as current assets. So this is something that the company has common with its competitors, right? Return on capital and return on equity greater than 20% in 5 out of the last 10 years, but both are below median, or both are below, in fact, 20% in the recent 5 years. So the first 5 years, or FY11 to FY15, were good years, and FY16 to FY20 have been, comparatively poor years, not just from an industry standpoint, but also from the company's historical performance, so to speak, right? EBIT margins have broadly been maintained, EBIT and PAT margins, although again in the recent years it's been, a sort of decline, so to speak, right? Capital and asset turnover have been on the lower side in the recent years, again, which is something characteristic of return on capital, margins, and asset utilization. So, what's the conclusion? The conclusion is the company has strong financial position. There's no doubt about the liquidity or solvency, but average financial performance on terms of return on capital and in terms of margins as well. Right, margins are still somewhere near the industry medians as well, but return on capital is, it's not as good as it's let's say a TCS or an Infosys, right? And the growth is the biggest challenge here, right? Because as we've seen in the 10 years, TCS has very rapidly outgrown Wipro, and Infosys has also outgrown Wipro, although Infosys was just smaller than Wipro 10 years back. TCS was a bit larger, but now the gap is just way too much, so to speak. So that is my understanding of the company. So that is all that I had to share about this company. I hope you found this helpful. If you did, please share it. The link to the workbook is there in the description. If you want to receive this and much more, you can subscribe to the WhatsApp list. You can subscribe to the YouTube channel because I cover new companies every day and you can get the best of investment analysis here. So thank you so much for watching and I'll see you again with another company.